Welcome to topic number 12. We are talking about intangible assets here. Our learning objectives for this topic is to look at identifying the cost that will be included in the intangible assets. How do we record the goodwill? What happens when the goodwill is impaired? Amortization of your intangible asset. We will also be talking about the revaluation model that is available for intangible assets, how the information is going to show up on your financial statements, and once again, the differences between IFRS and ASPE related to intangible assets. So first look at your intangible asset. So your intangible asset is your identifiable non-monetary asset that lacks physical substance. And your non-monetary asset is the one where you do not have any fixed right or claim to receive a fixed or determinable amount of money in the future. That is why your intangible assets are deemed as non-monetary assets. So some of the examples that we will see in your intangible assets are patents, copyright, franchise, licensing agreement, trademarks, trade names, any secret formulas, computer hardware, software, development cost. So there can be a lot of different types of intangible assets that are available. Now, your intangible assets does have the same similar idea as your property, plant, equipment. So if we have any intangible assets that have the same characteristics, such as your continuity, stability, or risk, then we put them in the same group and recognize them together, which means that they will be amortized together as well. In terms of recognizing the intangible assets, again, the criteria is the same as we apply for property, plant, and equipment. The only difference between PP&E and intangibles is the presence of physical substance or the lack of. So the recognition criteria that we had discussed under property, plant, equipment is the probable future economic benefit and the ability to measure the asset's cost. Now, keep in mind, whether your asset is property, plant, equipment, or intangible, it has to help the business generate revenue. So when these assets are acquired, they are measured at cost. But your intangible assets could either be purchased outright. Alternatively, these could be acquired as part of a business combination, or these can be developed internally. We will look at each one of these to see how to account for those. So if your intangible assets is purchased, this is purchased from another party. That means we will measure this asset at cost. So any cost that we have incurred to acquire the asset and any cost that is spent in order to bring that asset to a usable condition can be capitalized there. And that criteria is the same under the property, plant, equipment as well. So some of the costs that are not, you cannot capitalize are the ones that are related to the product introduction, any promotions, conducting business in a new location, or with the new type of a customer, or the general administrative overheads. So these costs are going to be expensed. They cannot be capitalized as part of the asset cost. Any expenses that we incur after the asset has been put into use are going to be treated as ongoing expenses. Now, if you do purchase a basket acquisition, meaning that several intangible assets are purchased together, then we will use their relative fair values to allocate the values and record those intangible assets onto the books. Now, what happens when the intangible assets are acquired as part of the business combination? So here, only those assets that are identifiable can be separately recognized at their fair value. The rest of the amount will be considered as goodwill. All the assets that are acquired in a business combination are recognized even though they may have been internally generated. So this is very specific to business combinations only. Internally developed intangible assets. Now, a lot of time the companies could incur cost internally to create an intangible asset, such as patents or any brand names. Internally developed intangible assets will present significant challenges related to recognition and measurement. Under IFRS, we are allowed to capitalize the cost when certain criteria are met. And this also applies to ASPE. However, under ASPE, we do have an option to expense these costs related to internally generated intangible assets. So when we are talking about the criterias, we need to put these items into two phases, either the research activities or the development activities. So depending on where that cost lies, we will have a different treatment for that. If you are uncertain about where that phase lies or where that item lies, then by default, we will go with the research phase. So any cost that goes into the research stage is always an expense. There is never an ability to capitalize the cost in research phase. But under the development phase, we look at 6 criteria. And if all of those 6 criteria are met, then we will go ahead and capitalize that development cost. So those 6 criteria are the ones here. So there has to be technical feasibility of completion, intention to complete for use of sale, ability to use or sell it, availability of resources to complete it, use it, or sell it, show how the economic benefits will be generated, that is, provided that there is existing market or usefulness to the company. You need to have a market to sell your product. Ability to reliably measure cost. If all of these 6 criteria are met under the development cost, then the businesses can go ahead and capitalize the development cost. The research cost is always going to be expense though. Now, some of the costs that can be included and cannot be included are discussed here. So the costs that can be included are your material and services used or consumed, any direct cost of personnel, fees that are needed to register a legal right, amortization of other intangibles that are needed to generate, and any interest of the borrowing cost. What you're not able to include in the capitalized development cost is the selling and administrative general overheads that are not directly linked to the process, any cost to train the employees, initial operating losses, legal and other cost of incorporation, pre-opening cost, relocation and reorganization cost, as well as advertising and promotional activities cost. So none of these costs can be capitalized. Now, there are 2 models that are available for measuring the intangible assets. ASPE only allows one model, which is the cost model. This is the most widely used model. The other one is your revaluation model. This is applied only to assets that have fair value, which can be determined in active market. Logically speaking, we cannot apply revaluation model to assets if the fair market value is not available. Now, both of these models are applied in the same way as for property, plant, and equipment that were discussed in topic number 10. When the revaluation model is used, all of the assets in the same class must use the same method. So you cannot mix and match your methods between cost and revaluation there. There is really no formal requirement for an annual revaluation as long as the reported carrying amounts are closer to the fair value. Your intangible assets also tend to fall in 2 categories related to their life. So either they might have the indefinite life, which does not mean infinite. It just means that we are not able to determine the life of that asset. Alternatively, you could have intangible assets with the finite or a limited life. So how do we amortize these assets? So the intangible assets with the limited life, as the name suggests, we are going to amortize the cost of those intangible assets over its useful life. If we don't have any obvious pattern of use, then the simplest way to amortize will be your straight line method. Talking about your indefinite or infinite life intangible assets. So your indefinite life intangible assets cannot be amortized because in order to amortize, we need to know what's the life of the asset. If you don't have the life, you cannot amortize that. Now, because there is potential effect on the financial statement, it is important for the management to review whether your intangible asset still has the indefinite life. Now, this is required at every accounting period under IFRS standards. Under ASPE, we say this is required only when the circumstances indicate a change of possible impairment. So any change resulting from the review are treated as the changes in estimate, which means that we will go ahead and account for that information going ahead. We will not change any historical information there. Impairment on your limited life intangible assets. Now, your impairment of the limited life intangible asset is covered by the same impairment models and the standards that we discussed in our long-lived tangible assets as well. So your potential impairment is assessed under ASPE when the events or the circumstances indicate that the carrying value is not the recoverable amount. However, under IFRS, this is needed at the end of each reporting period. So the two impairment models that we have available, under ASPE, we have the cost model or the cost recovery impairment model. Under IFRS, we use the rational entity impairment model. So conceptually then, your cost recovery model is assuming that the carrying amount is recoverable through undiscounted cash flow for future use and sale. Whereas your rational entity is assuming that the management will use the asset or dispose of it, whichever results in higher returns. So when you are thinking of your impairment, your recoverability test really is the asset is impaired if the carrying value is higher than the undiscounted cash flow under ASPE. So your carrying amount minus the fair value, that is the amount of your impairment. You are not able to reverse any losses in the impairment under ASPE. Your subsequent amortization, if the value of your asset changes, then we do need to update the depreciation or amortization amount going forward. Under IFRS rational entity model, your impairment is if the carrying value of the asset is higher than the higher than the two options, and those two options is your. Okay, we'll talk about that in our next slide here. So that is the difference between your carrying amount and your recoverable amount. Your reversal of the loss is estimated, and this is underlying the recoverable amount has changed. Your amounts of the reversal of the impairment loss is limited to the total loss that was booked. And once again, because the asset has been updated, the asset value has been updated, we have to go ahead and look at the updating your amortization amount. So you're higher of the two options. That is a change here. So when you're comparing the carrying value, you will have to compare that carrying value against two things. One is the value in use, and that value in use is the present value of your future net cash flows. You will also look at your fair value minus cost to sell. So when you look at those two, value in use and fair value minus cost to sell, you will take higher of those two amounts to compare against the carrying value. So if your carrying value is higher of these two amounts, then you are looking at impairment. Now, what happens with the impairment on indefinite life intangible assets? Now, this is very similar to your impairment of limited life intangible assets, except for the fact that under the recovery model, your impairment test is the fair value test. So which is your fair value is lower than the carrying amount that indicates loss on impairment or the impairment loss on the asset. Okay, in the earlier example or the earlier slide, we were looking at the undiscounted future cash flow. Here we are looking at fair value. So that is the only difference between the finite and indefinite life intangible assets. Now your trademarks and the trade names are your renewable assets. So the legal life of these assets could be different than the useful life. So legal life here could be unlimited, but the useful life could be different. Useful life is for how long can the business use the asset to help generate revenue. So when you're amortizing these assets, you are going to compare the legal life of the asset as well as the useful life. The smaller or the lower of those two is going to be used to amortize the intangible asset. Any cost that you have incurred on the trademark or the trade names can be capitalized. If your trademark or trade names are developed by the business, then only the direct cost can be capitalized if the 6 criteria for the development costs that we had discussed earlier were met. If the future benefit of your trademark are determined to be to have the indefinite life, then you're not able to amortize that asset. Copyright is an exclusive right of the owner and their heir to copy a creative work. The legal life of copyright is the life of the creator plus 50 years. Once again, you are going to compare the legal life of the asset against its useful life and amortize that asset over the lower of these two, legal and useful life. A franchise is a contractual agreement where the franchisor is going to grant the right to the franchisee to sell a specific product or a service and use the trademark or a trade name. So think of McDonald's or Subway. They are franchises. So a franchise may exist for a limited time or for an indefinite period. So if it is for the limited time, then we are going to amortize the cost over that limited life. If it does have unlimited life, then um, we are not going to be able to amortize it until we know the life. So that asset is going to be tested at a certain frequency to see if the life is finite. As soon as we find that, we will start amortizing the asset. Any annual operating payments for the franchise are treated as expense. Your leasehold improvement is, or the leasehold cost, is a contractual understanding between the lessor who owns the property and a lessee that is using the property. This is valid for a certain time period. Lessee will make specific periodic payments to the lessor. So basically here, the terms are more favorable than the usual market terms of any similar agreement. Patents are the products and the processes that the business can use in order to generate revenue. The patent gives exclusive rights to the holder for making, selling, or using products or process. The legal life of a patent is 20 years. Once again, we are going to compare the legal life against the useful life and amortize the patent over the lower of those two. Any cost that is incurred in purchasing the patent can be capitalized. Any research cost will be expensed, and most of the development cost here is going to be expensed as well. But once those 6 criteria are met, then we can go ahead and capitalize the cost. Any legal fees or any other costs that have been incurred to successfully defend a patent can be capitalized over the remaining useful life of that patent. If you have small modification or additions that may lead to a new patent, then it can be added as an extension of the old patent. And any unamortized cost from the old patent can be added to the new patent if it provides pretty much the same essential benefits. Now, what happens when we derecognize your intangible assets? Derecognition can happen through either disposition, we are selling the asset, or the asset is not helping us generate revenue anymore. So at that point in time, we will take the asset off our books, very similar to property, plant, and equipment disposition. So if there is no future economic benefit, then we will go ahead and derecognize these assets off our book, take the asset out, take the accumulated amortization if the contra account is attached off your books. And the difference between the carrying value and the proceeds will be your gain or loss in disposition. And those gains and losses on disposition are going to hit your net income. Let's talk about goodwill. So goodwill only comes into play when one business is acquiring another business. So when the purchaser is buying another business, what they are paying for is the net assets. And that net assets is asset minus liability. Necessarily, that's your equity. So if that net asset value is lower than the proceeds of the transaction, then the difference is viewed as goodwill. Goodwill can only be recognized onto the books if this is part of the business combination where the business is acquiring another business. Any internally generated goodwill cannot be capitalized. Now, how do we recognize and measure the goodwill? Now, as we said, the goodwill is only going to be recognized when the business combination occurs. Your purchase price is going to be allocated to the identifiable net assets. Any difference between the fair value and the carrying amount is then assigned to your goodwill. Now, if you had a bargain purchase where you have a negative goodwill, meaning that the equity amount was higher than the purchase price, that is negative goodwill. So we are not going to recognize negative goodwill onto the books. We will accordingly adjust the value of those intangible assets based on the fair value. Impairment on goodwill. Now, because goodwill is not identifiable and it does not have the ability to generate its individual cash flow, that is why goodwill is assigned to a cash generating unit. So other than the specific requirement, your impairment accounting for goodwill is very similar to intangible assets with indefinite life. So here under the cost recovery, we will apply your goodwill impairment test when the events or there are changes in the circumstances indicating that the value of your goodwill has changed. Under IFRS, the requirement is to do it annually and whenever there is an indication that your cash generating unit is impaired. So at the date of acquisition, under ASPE, we are going to be reporting goodwill as part of the on the operating segment or on one level below. Under the IFRS model, we take the goodwill as part of your cash generating unit. Now, the indication of impairment is when your carrying value of the reporting unit, including your goodwill, is higher than the fair value of reporting unit. The difference is your loss. Under IFRS, we look at the carrying amount of the CGU, cash generating unit, that includes goodwill. If that is higher than the recoverable amount, then the difference is treated as your loss. Your impairment loss is going to be allocated first to goodwill under IFRS, and then the remainder to the other assets based on their relative carrying amounts. Under ASPE, we are going to allocate that to the goodwill impairment loss, and the impairment test for the other assets in the group is done before the goodwill impairment test is done. The reversal of the goodwill impairment is not permitted under IFRS or ASPE when it comes to goodwill. Talking about what are the disclosures needed for your intangibles and your goodwills. So for your each class of your intangible asset and separately for internally generated intangible assets and other intangible assets, we need a lot of different types of disclosures. So some of those are whether their lives are indefinite or finite limited, useful life, methods and the rates of amortization that were used, carrying amount of intangible assets with their indefinite life, reconciliation between the opening and ending balances, and losses on impairment and reversal of losses on impairment if there were any. For each material loss on impairment that is recognized, we have to indicate the circumstances that led to its recognition, the amount that was recognized, the nature of the asset or the cash generating unit, and information about how the recoverable amount was determined. For each cash generating unit or group of units that has significant amount of goodwill or intangible assets with indefinite life, we are going to look at how the unit's recoverable amount was determined and underlying assumptions. For intangible assets that are measured using revaluation model, we indicate the carrying amount. The carrying amount if the revaluation model has not been applied, the date of the revaluation, and the amount of associated revaluation surplus and changes in that account. We also indicate the methods and assumptions used in estimating fair values. And finally, the differences between IFRS and ASPE related to our intangible assets. So the development cost criteria under IFRS, once those 6 criteria are met, we have to capitalize the cost under IFRS. ASPE gives us the ability to either capitalize or expense even after the criteria have been met. Impairment model that is allowed under IFRS is called as rational entity model. ASPE only allows cost recovery model. Reversal of your impairment loss is not permitted under ASPE. Under IFRS, it is permitted for intangible assets, but not for goodwill. This concludes topic number 12, intangible assets.